Tesla notching its best week in more than a year after a strong Q2 delivery report, turning positive for the year by 1.1% and more than 70% off the lows in April. Despite these big moves, our next guest thinks the stock is a sell still and has thought that for some time. Let's bring in Jan Jovsiko of Guggenheim Securities. Ron, I believe this stock is up a little more than 43% year to date. That's got to be painful if you got a sell on it. So why are you still convinced it's a sell?
Yeah, month to date. But yeah, it's been a very painful month.
Oh yeah, month to date.
Yeah, it has been a very painful month.
Just barely positive for the year, like I just said.
Yeah, exactly. Yeah, we've said a 5% demand decline, a 5% delivery decline has never looked so good. Ultimately, demand is still deteriorating for this business. It was a modest improvement versus the first quarter rate of change or the percentage decline in the first quarter. But it only gets harder from here in terms of even trying to claw back to even in terms of delivery growth. They've lost a tremendous amount of market share in China. And the pie in China has much less room to grow. China is now 50% electric vehicle exiting the second quarter. So if you're losing share and there's less overall kind of EV pie to grow, that's challenging. You have tariffs hitting in Europe this quarter, which will be an additional 20% cost on about 25% of Tesla's European volumes that come from China. And ultimately, the way they got there with delivery upside this quarter was some pretty heavy discounting and financing promotions that we think show up in the form of negative or down sequential gross margins when they report earnings this quarter.
Now, if Tesla were being valued by investors on car sales, right, it wouldn't have an $800 billion market cap right now. There's an expectation that the technology that Tesla is developing, AI, self-driving, is worth a lot more than that. So what is it that you believe will cause that faith in Tesla to collapse in the near term? Because isn't that what needs to happen for the stock to meaningfully fall from here?
Yeah, it's a great point, great question as well. I think over the next month, there is the chance that ahead of the Robotaxi event, this is kind of an increasingly noisy time period, both upside or downside. Just when you get summer trading into a very hyped up event, post the Robotaxi event, I think there will be a market realization that commercialization of Robotaxis is well into the future. For whatever reason, Tesla gets a very unique implied valuation in robotaxis that other startups or established robotaxi players today do not get. And ultimately, we think the event, the best case is a pretty aggressive timeline, but that kind of lacks credibility alongside a physical prototype. I'm not sure that's enough to support the stock at these levels.
Is there a case to be made that as long as risk assets, including, say, Tesla, even NVIDIA, and some of the AI names remain elevated from a valuation perspective, that Tesla will too?
Yeah, definitely. I mean, the correlation with both interest rates and the rest of, I would say, the higher beta tech stocks is quite high, and it's certainly recoupled in the last month or two versus, I think, the start of this year, the stock had tracked some of the negative fundamental revisions. So it's tough. I mean, but ultimately, we try and have a fundamental basis for our valuation. We do see the auto business continuing to deteriorate. And I feel like we have pretty healthy energy assumptions, even before this quarter's very strong energy print. And we can't get on a discounted cash flow analysis anywhere close to the current valuation. Our DCF's around 150. To be clear, our price target's 134.
What's the impact of cheap Chinese EVs and tariffs against them that might be seen as potentially benefiting Tesla?
Yeah, it could help Tesla. Our view was that BYD and others would never really be able to participate in the U.S. market. I think both political parties, it's probably actually one of the few things they align on. But ultimately, there is going to be increased competition in the U.S. from other manufacturers in the form of Rivian, and even the legacy OEMs should be developing more competitive, lower priced product. We've seen Hyundai, Kia come out with quite compelling electric vehicles in our view. But no, I mean, it is the case. But ultimately, if we're underwriting Tesla for the U.S. EV market, this is the most challenging electric vehicle market, I think, over the midterm. And it's much harder to underwrite that.